Okay, good morning, everybody. Welcome to Friday, the 7th of January 2022. We have NFP today coming up, but a bit of a chat that we got going in the Discord room this morning. Rob and myself looking at the interest rate cycle, right? So, not normally what you love to look at about 8 a.m. on a Friday morning, but it's really interesting to look back at when the Fed, coming out of the global financial crisis, obviously rates went down, bonds purchasing and corporate bond purchasing, mortgage backed security purchasing went up. So quantitative easing, right, going on. And we just wanted to have a look back at how did the Fed unwind that situation in 2015 um, from the liquidity they were putting into the market. How did they go to raising rates? But more importantly, how did the market respond to that? And how have we seen the market respond to the rate signaling, the rate hike signaling that we've seen this Wednesday gone, right? And um, so we went back in the S&P. We're going to have a look at that now. We'll get over to these charts and have a look here, right? And so here's where we sit right now on the SPOOs, 4682s. This is a weekly bar chart, right? So I'm gonna skip on back to the 2015 environment here, right? And we can actually go onto the dailies here, right? It'd be a bit more interesting to go back on daily charts here. And just up here. And here we go, right? So this may be interesting to people who are trading trading the SPOOs and trading equities, really trading any global equities. This would be interesting to see how the market did react back here, right? So I have a couple of percentage markers on here. But really, it was on the Fed meeting on, must have been, well, actually, sorry, it was Wednesday the 19th, right? Wednesday the 19th of, what was this? Wednesday the 19th of August 2015. Janet Yellen, in a meeting, signaled that they were looking to raise rates, right? Raise rates for the first time in 10 years coming out of the global financial crisis, right? Um, and you can see at that meeting, then we literally just sold down, and how far we went on this, really from the top of that day to the bottoming out on the following Monday, the 24th of August 2015. You can see there was a 13.3% sell off, right? Then, when it came to actually that interest rate hike coming into effect there on the 16th of December 2015, all right, you can see the market was trading at a high of 1997 evens, and then we effectively sold off on that day, but to the lower bound of this range that we've been working in here, right? So, just really looking back at how the market was reacting there, through that period, we can, have a naked look at this area here. So, we'd really sold off 13.3% down from here, all right? And so we just get the chart calculator on to look at that sell off. And if we copy this and move it over, you can see that really that was the range working to the lower bound, right? And I'm going to park this one here for now, just park this off screen. Um, I'll just park that over there. So you can see that the low put in after they signaled the rate hike, right? Let me zoom in here and take my mug off the screen. All right, you can see if I zoom in here, the low put in after that at 1740 evens really became the lower bound for trade once the interest rate actually came into effect. Right now, this is back adjusted. Okay, so this is we're currently looking at the H22 contract, the March 22 expiry, right? And this is back adjusted. I mean, I could back adjust this. I could switch this back to the H. Let's see what would have been. Yeah, I could switch this back to the Z15, which would be the exact contract and how it traded. But this is back adjusted, so I don't need to do that. Um, Normalized, we have a 13% pullback, and that was the lower range that we tested after the rate hike came into effect. So effectively, we can copy and move this percentile measurement, and that was the range that worked. And ever since then, so that was effectively in August, late August, and then December in that year, the rate hike came into effect. We retested that lows twice, on January 20th, 2016, and February 11th, 2016. And then, sure enough, off we go. Now, let's see where well, there's no prizes for guessing what the market did after that. But you can see that really on the 200 EMA at the time, really the mid of the range, essentially, right? But you can see what the market did. Now, before we look at what the market did, I do want to note here the range that the market seems to have been working in leading up to this rate hike signaling, and indeed the rate hike coming in, right? So this is our range, right? This is our range. And you can see we sort of pulled back to that range low and then sold down again. And it was quite an interesting area to note at the time. But really moving on here, and I actually do want to move into weekly bars now uh, to take note of this area. And you can see here now, it's a little clearer really what the market was up to. We look at the weekly bars and we can kind of normalize that range a little bit here. But this is the market, and so effectively look at what happened, right? After we tested that lower bound after the signaling and the 200 weekly EMA, it turns out at the time, we traded not only back to the top of the range, pulled back, then to the bottom, but the bottom of that range, we never traded that price again. We've done nothing but tack on insane, QE fueled highs, I suppose. But the quantitative easing remained in place for quite a while. Sorry, in terms of the purchasing. But you can see that we did, push on up. We pulled back into this area only once there on the week of the 7th of November 2016. But by and large, this has been one-way traffic. Oh, sorry about that. Just let me zoom back out. So this is been just one-way traffic since, right? On the top of that range, 2035s back adjusted. So really interesting to look at where we trade now in relation to the structure of what we had there. We had sort of the top of this range tested 1, 2, 3 times after signaling, and down we go, right? Just take that off. So 3 times before and after signaling, and then we went on up. Now, to show you where we are now, it's a little bit different, right? And we came into, we needed quantitative easing and central bank activity for different reasons this time, and I think it's we don't see the same structure to the market really. There is sort of a little bit of a range to look at here, but certainly I would actually argue we got a bit of a range here. But on the weekly bars, it's you're trying to shoot. It's like trying to shoot a buffalo with a potato gun. It's you're just really getting a nice contextual read on the market, but it's very hard to actually have a pinpointed trade on these things. But look, I'm not trying to solve the puzzle of how far we're going to sell off to, but just one thing I am noting is that we do have a gap open, still remaining open on the SPOOs back to the 29th of March 2021, right? So there is a gap there. There is a gap there. And look, am I saying that we're going to come down and fill the gap? No, but I am insinuating it. I am insinuating that, right? So look, that's a 14.5% pullback from where we trade right now. Are we going to get it? Who knows? I think it's all it's very easy. It's too easy to be the perma bear waiting for the big sell off. Shout out to PIQ on Twitter, who has been anytime I think we're in for the big sell off, he just holds me to account. And he's right. It is too easy to be bearish, perma bearish on these equities, waiting for the big sell off. The fact of the matter remains that we have accommodative Fed. They are talking about further stimulus talks in the Senate. Another round of stimulus. The mortgage-backed securities are still going on, albeit they're tightening, they're reducing, and we have signaling of rate hikes. But the Fed is still accommodative right now. We're who knows? We could have this new French wave of the variant could raise its head and be 10 times worse than Delta. So they do have to tiptoe around at the moment until we're kind of long free and clear of COVID. So I think that's why there are still buyers in this market. The Nasdaq is a slightly different horse in that we've seen really the real yield rising incredibly this week on the signaling of these rate hikes, and so therefore people are running for the safety of these bonds. And the best thing about that is that you're guaranteed your money back. On tips and all these treasury products, your money's safe, your principal is safe, and you're just really getting a nice dividend on the, well, not a dividend technically, but a yield paid out on that loan to the government, right? Whereas, if you're looking at the QQQs ETF or any of these Nasdaq products, or indeed one of these Nasdaq companies, very few of them are paying nice beefy dividends to supplement what you would get from a bond. And a lot of them are actually trading on 20 years forward earnings, like 20 EBITDA, whereas they should be trading on like 10 or 5 years EBITDA. So, you can come in with your price to earnings forward ratios all you want, but this market is high on its own supply. Apple, Facebook, Amazon, Tesla, they're the only ones making money in this index, really, to be honest. All right, it's the NASDAQ 4. Okay, so this is why we're selling off. And today, I'm interested to see if we come down, well, not 2 days trade, but I think if we come down and test this trade channel, I think that's why, it may be different this time. We may have capitulation. It's 50-50. Look, I'm not calling the market. I'm just making people aware of the contextual environment. That's all. That's all we try to do here in Dublin Capital, is to make people aware of the contextual environment, and then they can trade with their hypotheses on that context. All right. Anyway, I thought that was a quick, nice, interesting, quick look at the interest rate environment coming out of the global financial crisis. How did the Fed unwind, but more importantly, how did the market react to that interest rate hiking and untangling of that QE, if you like? And so, I'm sure this is going to be a hot topic this week and next week, and all the way through to March when they do actually drop the rate hike. So, yeah. All right. Listen. Have a great day. Have a great session. We got NFP 1:30 today, GMT. So do be careful out there. And yeah, we'll check you later. Thanks. Bye.